Private versus local building control, which is best? I'm a big believer that there's polarity with everything, and what I mean by that is if there's a positive, there has to be a negative. If there's a negative, there has to be a positive. So in any situation at all, it's about weighing up. If something appears really good, have a look at what the negatives are. If something's negative, have a look, because there's probably some real positives there as well. So private versus local building control, the difference being, local is when you're using your local council, for example. So you're going to your local council and they're doing the building regs, the building control on your project. Or you have private, where you can go to private companies and they do the same thing, except they've got the rights to be able to sign off work. Now, me personally, I've always used local, I've always used the council, and the reason for that is, one, if you're doing building works, I think it carries more credibility that the council have signed it off. The other reason is, if the private company, which sometimes people go to because they're a bit more lenient, if the council were to check on that, and they have the right to do so, you could be asked to redo work or even change things or redo the whole lot again. So for me personally, I've always liked to build that relationship with the council, get them to come out. If you've got a good relationship with them, you're doing regular work with them, then I find them really helpful. It's just about being proactive, so not getting them out too late and them saying, why haven't you done X, Y, and Z? If you get them out and you're proactive about it, then they can just steer you in the right direction. So for me, I prefer to use the local council, but I'm also aware that some people have great relationships with private building regs, building control, and that works for them. But that's the difference between the two. Setting up a property business. So people ask me, should I be set up as a sole trader or should I be set up in a limited company? Now, although I'm not an accountant and I'm not qualified to give you that advice, from a personal perspective, it depends on how many properties you're going to buy. So if you're going to buy just one property, it might be more beneficial just to be as a sole trader and not actually set up as a company. However, if you're going to treat this as something where you want to build it and build something sizable, then it definitely works out better to be in a limited company. Obviously, these scenarios can change depending on what's going on in the market, depending on what's in the Chancellor's budget. So make sure you check that with an accountant. But if you're going to build something of any sort of size, it's better in a limited company, because you can avoid Section 24, meaning you can offset your mortgage against your profits. Mortgage products. This is a question I'm asked quite a lot. Which product should I actually choose for my mortgage? So different products that you might get offered, and it can be quite confusing the first time, if it's the first time you've heard of a tracker, of a discounted mortgage, a variable mortgage, a buy-to-let mortgage, a fixed rate mortgage. So there's all of these different terms that are thrown around. So just to sort of explain what they are. A fixed rate mortgage is a fixed rate. It does what it says on the tin, so it might mean it's fixed at 4% for 2 years. These are great for people who want a budget, so they know that they've got a set amount. You can get a discounted rate, so it might be a Bank of England base rate and then a discount below that. You're certainly not going to see that right now because of the rate being so low. A variable rate is the bank's own rate, and that can go up or down depending if they want to move it. They've got the rights to move it at any time if they want to make more profit. Maybe they want to reward their customers because they've made lots of profit, so they bring the rate down. A buy-to-let product is basically a mortgage, which means it's the intention to let it out. You've also got tracker. So tracker tracks the Bank of England base rate. So let's say, for example, the base rate is 2% and the tracker is a +1. If the base rate's at 2, the mortgage will be 3. If that's 3, that'll be 4. If that's 4, that'll be 5. If that come down to 3, that had come down to 4. So it basically tracks the Bank of England base rate. Finding investors, the best way to do it. So finding investors is about the way that you come across. So people have this misconception that in order to get people to invest with you, you've got to have bags of experience, bags of knowledge, and you don't. People buy people. So what you've got to do is you've got to be trustworthy. So being yourself, just being honest is the most important thing. Never try to lie, never try to bullshit someone. Making sure you know your numbers is important. So don't worry too much about how much experience you've got, how many properties you've got behind you. Make sure your numbers work. So being able to demonstrate, this is what the property is, this is how much I'm able to buy it for, this is how much they actually sell for on the street, this is the returns on it, this is how long it's going to take to renovate, this is the team that's going to be renovating it. Making sure you've got your numbers and the information right around the property. So what's the area like? A little bit of information on your builders, what qualifications they've got. So the more you can stack that up, the more questions it's going to answer in your investor's mind of what happens if the builder walks off site, what happens if the builder's not capable of dealing with the job, what happens if I don't make enough profit. So by answering as much as you can, giving as much information and being well prepared in terms of creating a pack and knowing your numbers is way more important than how many properties you've actually got and the experience that you've got. And also remember with investors, these are people with money, and right now they're not making a lot of money in the bank. So you're doing them just as much of a favour, or you're offering them as much, should I say, as what they're offering you. So don't look at it as you're giving me money and you're doing me a big favour, because they're not. It's a two-way thing. You're helping them make their money work a lot harder, and in return you're obviously getting finance from them to build your property. So it's a two-way thing. So come well prepared with your numbers is what I would say. Come well prepared with your investor pack, and just be honest and be yourself. Flipping properties, should I be holding or should I be flipping? Well, again, it comes down to your strategy. The reason why I personally like holding properties is you get the capital benefit as they're going up over years, so you get the benefit of compound effect. And also by holding your property, you can build your rental amount, so the reoccurring income. So I use my assets to pay for my lifestyle. That's why I personally like to hold my properties rather than flip them. Now, saying that, I've flipped more than 50 properties during my time. So sometimes if the margins don't work that well, so let's say for example your mortgage is £600 and you can get 650 in rent, it becomes a bit pointless. But if you can flip that particular property and make 30 or 40 grand, it makes more sense to flip a property like that. So I do also flip properties as well as hold them. When I like flipping properties is when you're starting to gear back down. So I'm a big believer in reaching a certain income level that you want, that's very specific to you. Once you've hit that target, start gearing back down so we can do some properties that we flip, and then we can chunk off the amount that we own our portfolio. So let's say, for example, you had a £1 million property portfolio and it was geared up to 75%, so 750 grand. What you could do is once you start doing some flips, they can start to chip off that 750 grand. So they start to bring it down, meaning that you're less geared up on your portfolio. So for me, I do both. I do like to hold properties. I think it's important to do that, but I also think there's a time and a place for flipping properties as well.